Next, we will be describing different kinds of accounts. Brokerage accounts can be divided into two general broad classes: retail accounts versus institutional accounts. So a retail account is an account held by an individual, a couple, or a group of individuals rather than an institution. An institutional account, not surprisingly, is held by an institution. So it might be a bank, a pension fund, an insurance company, a registered investment company, a registered investment advisor, or any other person, including an individual with assets of more than 50 million in the account. And these types of accounts usually have less strict regulations because the SEC assumes that institutions are more knowledgeable than retail clients and better able to withstand risk. Within the category of retail accounts, there are individual accounts. An individual account is an account owned by one owner. So no one else can trade in the account unless you have explicit trade authorization, which would be signed authorization by the owner of the account. So you cannot give any information to anyone else on the account, even the spouse. When thinking about accounts, it's important to understand the different types of trading authority. So limited trading authority allows a third party to trade in the account, but the third party cannot make withdrawals from the account. If the third party has full trading authority, that means that they're able to make trades in the account, but they can also make withdrawals from the account. And then the final type of trading authority is called discretionary authority. And that gives the financial advisor, that might be the rep on the account, permission to trade in the account without permission each time. For discretionary authority, you have to have a dated signature from the customer granting this authority. And then that allows the rep to make trades later on without explicit permission. It's important to also understand what kind of trades or what kind of information you need as a rep to not have discretionary authority. And you need the action, whether to buy or sell. That means that the customer has to tell you on each order, I want to buy or I want to sell. You also have to know about the asset. What security? I want to buy Microsoft. You also have to know the amount. How much of the security? I want to buy 100 shares of Microsoft. If you don't have any of this information, if you don't have the action, the asset, or the amount, then you have to have discretionary authority in the account. These type of authorization records have to be kept for at least 3 years, 2 years at an easily accessible place. A joint account is an account in which more than one party can access and trade in the account. Both parties must open the joint account. The representative must maintain records on objectives of the joint account rather than the objectives of the individual investors. The financial information of both owners is combined for the purposes of the account. Both parties are allowed access to the account and may make trades in the account. The account must be closed by both parties. There are two main types of joint accounts. The joint owners must choose one of these two kinds of accounts. In a joint tenants in common account, which is abbreviated JTIC or TIC, the owners specify a percentage split among them. At an owner's death, the owner's percentage will be passed on to his or her estate rather than to the other owners. In a joint tenants with rights of survivorship account, the owners own 100% of the account jointly. When one owner dies, the other owner receives the entire account. Another type of account is called a transfer on death account. Upon the client's death, the assets in the account are transferred to the beneficiary. The beneficiary will not have to provide a will, only a death certificate to have the assets transferred. The assets will not go through probate, but will be subject to taxation. If there is a divorce, this account will not be divided equally among the two married persons. It will only go to the beneficiary. It is possible for a customer to open a numbered account. This is an account where only a number or a symbol instead of a name is used to identify the account. These kinds of accounts are used when the client wishes to preserve their anonymity. A client is allowed to open multiple individual accounts at the same broker-dealer, but the client must sign a statement that the account is not for another individual and that each of the accounts can be used as a guarantee for the client's other accounts. Both corporations and partnerships can open accounts at a broker-dealer. So for corporate accounts, when they open up the account, they must provide a copy of the corporate charter and as well as a corporate resolution. And what's really important about the corporate resolution from the representative's perspective is that it tells who is going to have trading authorization for the account, which individual at the corporation is allowed to trade on the account. And for partnership accounts, very similar. When a partnership opens an account, it has to fill out a new account form and provide a partnership agreement, which states who will have trading authority in the account. Another broad type of account are called fiduciary accounts. And those are accounts where a third party manages the account for a client or for a beneficiary. And that third party is called a fiduciary because they have a fiduciary duty to the client or the beneficiary. And that means that they have to put the interests of the client or the beneficiary ahead of their own. These types of accounts include investment advisor accounts. They are also accounts for bankruptcy trustees, executors of estate accounts, or guardians of minor accounts. A very common type of fiduciary account is called a Uniform Gift to Minors Act account, but usually referred to as an UGMA account. And that's an account where a custodian who's an adult opens and manages the account for a minor. Now, a very important rule that might appear on your test is that there can only be one custodian and one minor. The minor and the custodian don't need to be related, but the custodian must be an adult. Now, the assets in the UGMA account are transferred over to the minor when the minor becomes a major legally, usually when they turn 18, but it depends on the state. The custodians have third-party trading authorization, allowing them to make trades and withdrawals from the account. And that's because the minors are not old enough to make trades. An account always has to be opened for someone who is an adult, legally competent, and they have to be alive. So the minors cannot trade in an account. Here is some additional important information about UGMA accounts. Regarding taxation, the first $2,200 of earnings are tax-free, but above $2,200, the earnings are taxed at the parent's tax rate. Another important piece of information is that gifts can be made to the account from other adults, but all gifts are irrevocable, meaning if a gifter changes his mind, too bad. Once a gift has been made, it cannot be retracted. It will stay in the account. Gifts can be either cash or fully paid securities. Custodians on UGMA accounts have a fiduciary duty to the minors on the account, and this means that they have to put their minors' interest before their own. So any funds that are withdrawn from the account must be used for the benefit of the minor, and that comes up sometimes as a test question. Whether certain money can be withdrawn, it can be if it's for the benefit of the minor. Now, if a custodian wants the assets to transfer to the minor at a later date than the age of majority, the custodian can open a Uniform Transfer to Minors Act account. And those accounts often have a later and more flexible age of transfer. An investment advisor is a person or entity that advises people on their investments for a fee. Investment advisors often open accounts at broker-dealers to buy and sell securities for their clients. Investment advisors are considered fiduciaries and must therefore put their clients' interests before their own. Investment advisor accounts are typically held in the client's name, but the individual advisor has limited or full trading authority and makes most of the trades in the account.